Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Where on earth do you go when you have a real estate question? Well, how about this show? Every day, folks are submitting questions to us, and every few weeks, we do a show called Ask the Guys. That's today. Your questions, our answers, and we can all learn a lot on the Real Estate Guys radio program. In uncertain times like this, it's great to know there are two things you can always count on: high demand for affordable single-family homes to live in, and Terry Kerr's amazing Memphis team at Mid-South Home Buyers to find, fix, and manage the next addition to your recession-resistant real estate portfolio. The Memphis market is a logistics and distribution dynamo with an economic engine that's essential to moving goods and critical supplies all over the United States. Quality rehab, proven profitable property management, affordable rents, and solid ROI make turnkey property investing through Terry's team a dream when it matters most. To learn more about Memphis and Mid-South Home Buyers, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com. Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms. With me, as usual, our financial strategist and co-host, Russell Gray.
Hey, Robert.
One of the very greatest things we get to do is answer your questions. I was just at the MFIN conference in Houston, met a bunch of awesome people there, talked about all kinds of stuff. Must have had 100 questions. On the radio, we have the opportunity to answer questions every 8 or 10 weeks with the segment we call Ask the Guys. That's today's show. You can send off a question to us. We'll do our best to answer it. Here are the disclaimers. Russ and I are not tax or legal professionals, and we don't give advice. We just give ideas and information. So with that, here we go. Question 1 comes from AJ in Santa Clara, California. Greetings. I live in Silicon Valley and fortunately have a fair amount of equity. Yeah, doesn't everyone that lives in Silicon Valley? Around $600,000. If I sold, my plan would be to buy 3 single-family houses, one for cash, and then finance the other 2. I'm in my late 50s, if that has any bearing. Your thoughts? Thanks, AJ. AJ, great question. Both of us hail from your area. We actually met when we were living in Silicon Valley, and lots of people in that market have equity. We have plenty of investors and friends who are thinking about what you're thinking about. I've got this equity. It's not doing much on my balance sheet. Do I access it some way, or do I sell? So I think the idea is we're going to take this from the point that you've made the decision to sell, because we're not going to give you advice about that. If that you had made that decision, if you said, yeah, I'm going to take my $600,000, how can I deploy that into houses? Let's talk about the strategy Rusty has, owning one outright, one for cash, and financing the other 2.
Yeah, well, first of all, you can access your equity without selling, so that's an option, just putting that out there. But either way, whether you sell, and you get tax-free money, by the way, when you do that, at least up to a degree, depending on if you're married or not, in your capital gains, up to $500,000, I believe, is the latest for married couples. But with that said, the idea of having a house that's paid for, it's not bad in terms of security, but it's really bad in terms of the use of the equity because the return on investment is very low. Basically, you're saving what the cost of a mortgage would be, which is these days about 3%. And the other thing is it exposes the equity to liability. And it's not liquid. If you ever needed to tap into that equity, you'd have to apply for a loan and get approved, and you'd have to be in a healthy lending environment. So it's very illiquid. And the other thing is it's exposed to the public. People can see it. If you take the title in your own name, I mean, if you're going to have a property that's paid for, I suppose you could form an entity for privacy purposes and asset protection purposes. But the house itself is a liability. If you have a dog or you back over the neighbor's dog or there's some trip and fall on your property, a plaintiff's attorney could go after the equity in the property and you haven't hidden it. Now, it's possible to put a lien on it, and that's more of a sophisticated equity protection strategy, but the easiest thing is just not to have any equity there. I'm a big fan of putting a mortgage on the property, getting the tax breaks, and then arbitraging that. If I can borrow money at 3 and invest at 9, I'm going to do that all day long. In fact, you could make the argument that you could take the equity out of your property and get it to cash flow much higher, to the point where it's really subsidizing the other properties, especially the one that you're going to live in. And I suspect the reason that you want to pay the property off is that's the one you're going to be living in and you don't want a house payment. but your equity can actually make the payment for you if it's invested elsewhere.
Well, that's a really great point. In fact, we've got a couple of questions coming down the pike today that are going to relate to this. One, which has to do with how you structure your holdings. So that's the asset protection side of things. But also, I think the big picture here is peace of mind. A lot of folks decide they want to own their home outright, so they just don't have a mortgage payment. And I completely understand that. At the same time, that's a lot of equity sitting there doing nothing, kind of like it is right now. And that you are subject to mean Mr. Market. If the market were to drop suddenly, all that unfounded equity is gone. And it's true for the house you're in now, and it would be true for the house you own for cash. When you have a loan, however, the rules are different. If you bought a house for $200,000 and got a loan for $160,000 and the value of the house dropped to $150,000, you don't get a margin call like you would in the stock market. You still have that loan. You still have that house. You may say, well, what good is it because there's no equity in it? But the point is the lender isn't coming to take it away, and other creditors and things aren't looking at it as a target. So part of your decision, AJ, isn't just what to do from a financial point of view, which I think we've kind of addressed, but also just thinking ahead and being prudent about it. There are definitely legal and tax considerations, but we're definitely in favor of doubling down on real estate. You have this equity that's sitting there. Is there a way to strategically pick markets that make sense and for that to give you some return? There's another strategy that's a little advanced. We're not going to talk about it, but we're going to give you a good resource for it. And we just put together a series, and when I say we, I mean Russ and a bunch of great guests, called Precious Equity, which isn't about this, but it does share this idea of arbitrage. Where do you go to get 9 or 10 or 12% on your money that it's safe and protected? And there are places, and that's covered in the series. And if you were to, say, borrow more money at a lower rate, which of course today, although interest rates have edged up a little bit in recent weeks, they're still really low. You borrowed at 3 or 4% and put your money to work at 8 or 9. Now, in addition to the real estate, you'd have that difference, that arbitrage, that spread. If you want to learn more about that strategy, send an email to preciousEquity@realestateguysradio.com. So thanks, AJ, for that question. Let's shift from AJ to EJ. The next question comes from EJ in Washington, D.C. Hey, guys. Love the episode on getting started in real estate investing. I'm 31 and bought my current property in 2017 here in D.C. I've been hooked on real estate ever since. I sent in my application for the California real estate exam and plan to move there in the near future to be closer to friends. I wanted to ask, would you ever recommend a master's in real estate? I've looked at a couple of programs, and there's a chance I could get my current employer to help pay for it. Happy to provide more information, and thanks in advance. Cheers, EJ. All right, EJ, well, that's a great question. We know some people that have master's degrees in real estate. I know at least one person who's in the middle of that program right now. So I'll give you my advice, and then I'm sure Russ will chime in. I don't think you'll ever be hurt by being more educated. I mean, if you take the classes necessary to receive a master's degree in real estate, you're going to learn at a more granular level a lot about real estate. Having said that, I'm not sure how useful much of it's going to be. We are around very sophisticated, very successful real estate investors all the time, and I don't know any of them that has a master's degree in real estate. I know a couple of them who hire people that have a master's degree in real estate. So I'm not a big fan of deferred gratification from the education point of view. So if you're going to do it, make sure you're working as you go, you're investing as you go, you're learning as you go. Most people that want to get a master's degree are looking for a job. They want to be in the E quadrant, as Robert Kiyosaki would say. If you want to be an entrepreneur, I don't really see a reason you need a master's degree.
I agree. I mean, if you read Robert Kiyosaki's book, Why A Students Work for C Students, he explains the difference. The purpose of getting a degree, well, you certainly will learn things and you will build relationships. A lot of times you learn a bunch of academic stuff that is designed to fill up textbooks and fill up a curriculum. And it's good information. The problem is when you go in the real world is a little bit messy. It's a little bit unstructured. It's a lot more intuition and common sense and relationships. And I see people who come out, especially young folks, who come out with their finance degrees and then they get into business and they try to make what they're seeing in the real world fit into the model they were taught in school. Now, they struggle. Now, with that said, I have to tell you, I'm not qualified to have an opinion because I didn't have the patience to do that. I believe in mentorship much more than sitting in a classroom. So I got apprenticed early in life in business, started my first company when I was 19 years old. I bought my first piece of real estate when I was 19 years old. And I've just always worked through relationships, through mentors, and a lot of self-study. Now, I can tell you, I've been in a lot of conversations with PhD economists. And after 10 years of self-study, I can stay in that conversation. I mean, I'm not at their level, I don't think, and I don't have the credibility. If I was out there marketing myself, I'm kind of a do-it-yourself, like a George Gammon type of, economist guy. But if you find something that you're hooked on, that you love, and that's what you opened up with, any source of information is great. But I do think that, if you had to pick between real-world education, being around real-world people that are doing what you want to do at a real-world level, I would favor real-world. If you can do both, great. It's not going to hurt you. But then when you get into conflicts, when your schooling conflicts with what you see in the real world, I would say defer to the real world because that's where the money is.
I did, because I'm an overachiever, I did go to college for 5 years, not just 4. And it was great. It was an awesome experience. I won't say I didn't learn anything. I certainly did. But the biggest thing I came away from after a college education were the friends and the people I spent time with, not the classes that I took. I've never needed a college degree for anything I've ever done in real estate, and we've done a lot. So not trying to say no. I've got a friend right now who's taken a master's program in his 40s, and he's loving it. Now, he's a guy that has spent time investing. He's in our syndication mentoring club. He's doing the thing, and he's really taking this course, and it's online today, so that's how it fits into his schedule, for personal interest and because he's around a lot of young folks. He calls himself the old man of the class, which is great. So I think you got to examine your reasons. If you're expecting a degree to give you any additional success in real estate, I don't think that will happen. But great question. It's Ask the Guys today. Your questions are answers. If you have a question for the Real Estate Guys, all you have to do is go to our website at realestateguysradio.com. Click the button that says Ask the Guys. Every few weeks we do a show like this. When we come back, not only will we have more questions, but a special guest. Next on the Real Estate Guys radio program.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from April 16th to 19th in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 15 years now. And with the Belize airport open again, our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful. The people are wonderful. And wait till you taste the food. But the real opportunity is the real estate investment potential. Demand for offshore real estate has skyrocketed since the coronavirus shutdown. And with retirees looking for lifestyle, the work-from-home workforce able to be productive from afar, and tourism coming back strong, now may be the perfect time to consider Belize as a place to diversify risk in your investment portfolio. There's all types of opportunity in Belize when it comes to real estate investing, including both long and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and contracts are in English. And in Ambergris Caye, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me April 16th through 19th in Ambergris Caye, Belize, as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so that you can follow up with them after the trip if the market seems interesting to you. You've heard about Belize on the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on Events, where you'll find the Belize Discovery Trips. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize, April 16th through 19th. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under Events and I look forward to seeing you in beautiful Belize.
Hey, it's Kyle Wilson, Jim Rohn's 18-year business partner, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station, all the time at realestateguysradio.com. It's your show this week. Ask the guys your questions and our answers. If you have a question for the Real Estate Guys, just go to the website at realestateguysradio.com and click the button that says Ask the Guys. This next question comes from Tim in Grand Haven, Michigan. Hey guys, as always, I absolutely love your show. I listen to all of your podcasts at least 5 times each, for real, he says. And I have not just my friends in the U.S., but also my family in Sydney, Australia, listening to you guys as well. What you offer is truly invaluable, and on behalf of listeners everywhere, thank you for all that you do. Well, thank you very much for those kind words, Tim. He does have a question. My question is, how do I house my housing? What I mean is, what's the best vehicle to purchase and protect my real estate assets in? What are the pros and cons of buying in my personal name versus an LLC or a trust? I haven't gotten into the market yet, as I'm waiting for a correction to take place before I do. But when the time is right, I want to be ready. Any direction would be helpful. Thank you again for all the resources you provide, Tim. Well, this is what we call, Tim, a legal question, which would be the excuse for Russ and I not to answer it, even though we have some thoughts. But the good news is, joining us for this question, it is our longtime friend and real estate attorney, Mauricio Raoul. Hey, Mauricio.
Hey, guys. How you doing?
We're good. We're excited to have you pop in to Ask the Guys and help us out with a legal question. People often ask legal and tax questions, and this is a great one. And it's a pretty good one anyway. It's kind of a basic question about asset protection, but take us through this. What are the pros and cons of how you carry property?
That is an excellent question, actually. And the easy way to answer that, Tim, and thanks for the question, is you generally don't want to own property or really any asset that's valuable and that has some liability attached to it, like a house, in your personal name. That's sort of a good general rule. Why? Well, if it's in your personal name, that means that you, the individual, are 100% responsible for anything that happens in that house, and your exposure is unlimited. Right. So, for example, if you're buying a rental property that you own in your personal name, which I know a lot of real estate investors do, if something were to happen to that tenant, if somebody slipped and fell on the property, or maybe, a pipe blew or a boiler exploded or something causing some kind of an injury, then the owner of the property is legally responsible for that injury. And that would be you. And so let's just hypothetically, somebody slips and falls, gets injured, wants to sue the owner of the property for $10 million. There's a judgment, that's going to be $10 million on your watch. So we want to avoid that. And luckily in the United States, we have a system where we can create these entities that are legally separate from you. And the most favored one for asset protection purposes, as you mentioned in your question, is a limited liability company, an LLC. And the LLC is considered a separate entity, a separate legal entity from you. So ideally what you want to do is you want to house or have that property owned by an LLC, which in turn you own. So you own the LLC and the LLC owns the house. Now, again, that's sort of a basic. You can get much more complicated, but I'm just trying to lay the foundation here. That way, if you have the same set of facts and circumstances, if something were to happen to the property, again, a tenant slips and falls, they're going to sue the owner. And who is the owner? The LLC, right? So now the LLC is responsible, and I can generally only get to whatever assets that LLC has, which generally is going to be the equity in your property. So yes, there's still some exposure, but at least you've limited that exposure. That's why it's called a limited liability company, because you've limited that exposure to the value of the property and whatever other assets are contained in that property, in that LLC.
So thanks for that, Mauricio, because this is important to get your mind around. People start to study asset protection and they say, well, if I just have it in the right entity, then I can't lose. Well, that's not the case. If there was to be a slip and fall in this example and they were to prevail, the tenant or the postman, whoever it was to prevail, then they might be able to get to the assets within the LLC. What you're protecting aren't those assets. You're protecting the rest of your life because you create kind of these firewalls between assets.
That's exactly right. And so generally, if you have more than one property or you have multiple assets, whether that's property or precious metals or other investments, if you house those, as you mentioned, in different LLCs and different entities, then you're right. You're kind of cutting off that. They're all compartmentalized so that if something happens to one property, you're only exposed in that one property, as opposed to if you have everything in your own personal name, or maybe just as bad, have 20 properties in one LLC. Well, all of those properties will be exposed because they're all owned by the same LLC, and the owner of the property is who is legally responsible most of the time for the incidents, and the owner here would be the LLC.
So awesome. Now, Tim wanted to know the pros and the cons. So there's a lot of pros for LLCs. We use them a ton. But I think one of the negatives to think about is, Mauricio gave the example of 20 properties in one LLC. If I put 20 properties in 20 LLCs, one of the cons is just it starts to add up in cost and maintenance and management and time and all that. Can you speak to that?
Yeah, that's pretty much the main con, especially if you live in a state like I do, like in California, that basically will cost you, $800 a year to have an LLC. So now I have 5 properties and I put them in 5 separate LLCs. Well, now I'm looking at 5 times 800, which is not a good scenario. So the cost is definitely a mitigating factor, or that's one of the cons. The way we mitigate that a little bit is we generally don't put one property in each LLC, especially if it's a single family home where maybe there's $50,000 or $100,000 in equity. We tend to group them a little bit together, maybe 2, maybe 3 houses in one LLC to kind of mitigate that cost. Now, everyone's different, so it just depends on your risk tolerance, right? So if all I have is one home and $50,000 is all of my net worth, then obviously that's different for somebody who's got 20 of these properties and has $1 million in net worth, and this is only 50,000. So it really depends on how comfortable you are in terms of how many properties do we put into each LLC. I would go no more than 3, and again, depending on how much equity is in there. You just want to realize that every single property in that particular LLC is exposed to each other. So that's the con there. So if we group too many together and something were to happen in property number 1, they can get to property number 2 and property number 3 if they're all inside the same LLC. One of the things I also want to stress, Robert, is that there isn't a one size fits all, right? Everyone has a different scenario, different set of circumstances, different risk tolerances, different states that they live in, different costs. So all that has to be taken into account before coming up with a sort of an asset protection plan, an individual asset protection plan.
Well, it is that. It's a plan. And I like the fact that Tim's thinking ahead, but it evolves as you evolve, as you put different types of properties. We're fans of putting the types of properties that have the same risk profile together. You mentioned single family homes with, long-term leases. Those aren't especially worrisome. If I have a construction site and there's people hired in heavy machinery and all that kind of stuff, it's on a busy road. Well, that's a different profile. So you want to think through that kind of stuff. Now, Mauricio, Tim also asked about a trust, and that's an interesting topic. Can you speak to that?
Yeah, I get that question every so often. And the most important thing I can tell you is that if you're talking about a living trust, which is a revocable trust, which means I can, as the person setting up the trust, I can always change the terms whenever I want. Those have absolutely no asset protection value whatsoever. They're not meant for asset protection. They're simply an estate planning tool, which essentially allows you to pass on your assets without having to go through probate and dealing with that expense and that timeline. Having a living trust makes a lot of sense, but it's not an asset protection tool. So if you think that you're protected because your home or your assets are in your living trust, you're mistaken, and you want to recognize that. Same thing, which is common a lot in Florida, are these real estate trusts, or these
land trusts.
The land trust. Thank you, Robert. So the land trust, same thing. It's very popular in Florida, and they have some benefits from a privacy standpoint and an ease of transfer. But again, those are typically revocable trusts, so they don't have any asset protection value whatsoever. The only trust I would consider housing my properties, and I wouldn't even do it directly, is what we would call an asset protection trust, which is an irrevocable trust, which means once I set it up, I can't mess with it. I can't change it. I can't change the beneficiaries. I can't change anything. Those have asset protection values because those are completely separate. I still wouldn't have the property inside that trust. I would still first have that property inside an LLC and then have the trust own the LLC from an asset protection standpoint. But make sure that trust is a asset protection trust or an irrevocable trust for it to have any asset protection value.
Again, these are ideas and information, and you definitely want to sit down with an attorney before you make any of these moves. I would just caution folks not to try to do it themselves. There's a lot of create your own entity kits on the internet, and just be careful with that. You know, Mauricio doesn't do asset protection. I mean, you take care of clients and so forth. For a long time, this was one of your specialties. Today, you're primarily a syndication attorney, securities attorney. In fact, it just so happens that next week, Mauricio is going to be a guest on the show. There's a bunch of legal changes that have come down the pipe, and he's going to share those with us, so make sure you tune in for that. But Mauricio, I also know you have some more in-depth information. I know we didn't talk about charging orders, another brilliant protection of the LLC, but you've got a video put together some time ago on the basics of asset protection. Tell us about that.
Well, that goes in a little bit more depth. I mean, we actually just talked about one of actually two angles that you want to look at from an asset protection standpoint. One is we just talked about what happens if something were to happen in your property, something happens to your asset. That's what we discussed. But there's another issue that you want to think about, which is what happens if something happens to you unrelated to your properties. And now they've got a judgment against Robert, and now they're going to go after Robert's assets and they want to go grab the property. That's a different analysis. And that's where things like the charging order and the state where you set it up becomes important. And that's some of the things we go through in the video. It's
called The Basics of Asset Protection. If you'd like to take a free look, all you have to do is send an email to CYA, cover your assets, CYA at realestateguysradio.com, and you'll be able to take a look at that video and learn more from Mauricio Raoul. Thanks for popping in today, Mauricio, and we'll look forward to talking with you in more detail next week.
Me too. Thanks for having me.
There's attorney Mauricio Raoul. More when we come back. Your questions, our answers, and we're going to ask you a question as we play Real Estate Trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide. You're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Real Estate Guys listeners, are you tired of losing real estate deals due to financing issues? Have you had enough of waiting on banks, lenders, and investor groups to fund new projects? What if there were a way to eliminate all the hassle and invest in real estate on your own terms? I'm here to tell you there is. Patrick Donahoe here from Paradigm Life. I'm an Investopedia Top 100 Most Influential Financial Advisor, and I recently wrote a best-selling book about the financial strategy that changed my entire investment model, and the one that could change yours. To get a copy of my book for free and learn how you can maximize your real estate portfolio by acting as your own bank, send an email to mybank@realestateguysradio.com. Don't make another real estate deal without reading my book first. Email mybank@realestateguysradio.com now to get your copy for free.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hi, I'm Robert Kiyosaki, and I encourage you to listen to those wild and crazy real estate guys. They're the best, been working for years, and they know what they're talking about.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Tell a friend about the Real Estate Guys, and if you have a question that you'd like to get on to Ask the Guys, just go to the website at realestateguysradio.com and click the button that says Ask the Guys. Before we get back to our questions, it's time for us to ask you a question as we play our weekly edition of Real Estate Trivia. In just a moment, I'll ask you a question that has something to do with real estate, and when you think you know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. You'll need to send us your name, the answer to the question, and your mailing address, because if you're the first one that gets it right, we're we're going to send you a cool book called Life-Defining Moments from Bold Thought Leaders. It's a collection of great insights and lessons from some really cool folks put together by our friend Kyle Wilson. That could be yours if you know today's real estate trivia question. Last week, we were talking about the next generation of real estate investors, and we asked this. The television series 8 is Enough was set in Sacramento, California, but the actual house they used was not. Where was the home used on 8 is Enough? Well, the Bradford home from 8 is Enough was formerly located in Studio City, California. The residence was torn down in 1996, and a new house stands in its place today. By the way, that same house found its way onto television in lots of places. It was on episodes of Murder, She Wrote, Quantum Leap, and as the house Mike Tyson grew up in the movie Tyson. Here's our real estate trivia question for this week. To which U.S. state did the most people move in 2020? Every year, people are moving in and out of cities and states, and one state benefited the most from in-migration last year. Which state was that? If you know or just want to take a guess, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Give us your name, your guess, and your mailing address. The first person that gets it right gets the book Life-Defining Moments from Bold Thought Leaders. That's today's real estate trivia question. Speaking of questions, today is our Ask the Guys program. Your questions are answers. If you have a question for the real estate guys, go to realestateguysradio.com and click the button that says Ask the Guys. This next question comes from Shane in Enfield, New Hampshire. He says, guys, thanks for your absolutely amazing podcast and knowledge. You know, when you start with a nice comment, it's another way to get your question read. If possible, I'd love your thoughts on the pros and cons of paying off rentals versus continuing to leverage. Okay, this is going to be good. We kind of had that first question from AJ that talked about this a little bit. We're going to get into more detail here. He says, your podcast has helped me understand the power of real estate leverage and using inflation and the tax benefits of leverage. However, as a risk-averse person and wanting a less stressful and less risky lifestyle, I'm an agent with high stress and no work-life balance as it is, I like the idea of having 3 to 5 paid-off rentals versus 10 to 15 leverage, just because there's less to manage and more passive income to alleviate stress and be less dependent on my career or annual income. I hope seeing the question from that context helps so that you're able to provide some insight or advice. My personal investment philosophy is to replace as close to 100% of my primary income as a realtor with passive income, and the primary goal is to have more time and option freedom than to maximize net worth. I currently make around $400,000 annually and have about $20,000 to $26,000 passive income with 1 paid off rental and 1 leveraged rental at the age of 29. Thanks in advance. All right, Shane. Well, first of all, congratulations for doing 2 things. 1, being successful in a career of real estate, and then 2, taking some of those proceeds and investing in the product you sell. The godfather of real estate, my dad, would be very proud of that. So this is a great question because, first of all, there's not one size fits all. You mentioned personal investment philosophy, and it really is important you get in touch with that. If you were to say which is better, 3 or 5 paid off rentals versus 10 or 15 leveraged, I don't think there's an automatic better, but let's talk about the pros and cons.
Yeah, well, by the math, the more properties are better if you do the math. But your primary criteria here is lifestyle. And this is where I think a lot of real estate investors miss out on the benefits of looking at their portfolio the way a financial planner would. I have a little bit of background in financial services. I was a registered representative for a little while, and I helped people kind of structure portfolios, and I studied the concepts of financial planning. And when I got into the real estate space, I realized that everything you can do from a paper asset perspective with portfolio balancing and diversification and all of the things that you hear, asset allocation, all of the things that you hear financial planners talk about, you can do with real estate and real estate related assets. What a lot of real estate investors skip over is being on the debt side of things. What you've got here is a situation where you're thinking, I'm going to own less houses, and so I will be out of this management stress. And I'm saying that you can have passive income without management stress when you're on the debt side of things. In other words, where a traditional paper asset investor would allocate as they're moving from equity growth, they would move from stocks over to bonds for income. You don't hear a lot about that these days because bonds pay such a low yield. But mortgages pay a better yield, and you wouldn't be competing with the 3 and 4% that you get from the Fannie Freddie subsidized loans, because people who can borrow that money are going to borrow that money. But there are people who don't qualify for that money. There are foreign nationals that come here that have good balance sheets, they have good income, but for whatever reason they don't qualify and they want to buy an investment property. There are people out there where you could earn 6, 7, 8% on your money on the debt side, and you don't have the equity risk. You don't have to worry about if the property goes down in value. You don't have to worry about if the water heater blows up or the dishwasher breaks or anything like that. You don't have to worry about any of that kind of stuff. And your exit strategy is actually better than a bond because you buy the mortgage and you get the income coming in. And if the person doesn't pay, if they go bankrupt, then you just foreclose on the property and you can sell the property to settle your debt. You can rent it out and become a landlord if you want to do that. Or you can sell it to someone on an owner carryback, either an investor or an owner occupant, depending on the property and what yield you can get. And then you just create a new note. You can't replace a borrower in a bond. If the bond goes bad, the borrower's broke, you lose. But with a mortgage, if it goes bad, you either get the income or you get the property. And if you get the property, then you have choices about what you can do. And so I would say before you completely decide to lower your return on investment and not have exposure, you might take a look at the yields you can get by being on the debt side of things.
Yeah, that's a great call, Russ. The other side of it is do the math, and the math will tell you what to do. I said there's not a right or wrong, and Russ went right to the math. Math says you'll earn more leveraged, and that's true. In fact, on an individual property, depending on where it is, the ROI cash-on-cash return might be better on a leveraged property than on a non-leveraged property. So the assumption that, a few houses with no debt will make me more money or as much money as more houses leveraged may not be true. So check the math there.
Well, there's the tax breaks too, Robert.
Yeah, absolutely. And tax breaks, depending on what your situation are. I mean, if you're earning $400,000 a year, I think tax breaks of leverage are worth looking at. So there's just a lot to think about. But I would also say, Shane, that there is a hybrid strategy. First of all, when I had 3 or 4 rental properties, I had a lot more management headache than when I had 15 or 20. Because with 15 or 20, you absolutely have to have strong, professional, third-party management, someone else dealing with it. It's as though it were a note. It doesn't take much stress at all. Today, very little stress from property management because it's all done professionally. So there's another assumption to check. Is fewer properties less stress? I would argue if I only had 3 properties and one had something go terribly bad, that's a third of my portfolio. If I had 15 properties and one went terribly bad, well, that's less than 10% of my portfolio. So the point of that is just think through the whole thing. The hybrid I was referring to might be, back to the first question we had from AJ, own one free and clear so you have that peace of mind and leverage the rest. And I don't know what the numbers are or where your properties are, any of that kind of stuff. But the point is, really spend some time thinking about this. We've just highlighted some of the things to think about, like investing in debt instead of just in houses. And as a real estate professional, I'm going to guess over the years, you'll have plenty of opportunity to find those kinds of deals on both sides. It's Ask the Guys. Your questions, our answers. Our next question comes from Patrick in Boston, Massachusetts. Hello, real estate guys. I've been listening to your podcast for over a year now. I'm interested in joining the Belize Discovery trip coming up in April. But before I pull the trigger, I'd like to confirm a few things, if that's all right. Is this an appropriate trip for someone brand new to real estate investing? Does the programming occur each day from the 16th through the 19th of April? And if this is the case, I assume the travel days would be the 15th and 20th. Is there any recommended airline or discount code given after signing up for the trip? And is there a recommended budget? Thanks for all your great content. Hope to see you in April. All right, Patrick, well, we do the Belize Discovery trip 2 or 3 times a year. We've been doing it for 15 years, and it's really to show you the market. The trip starts on Friday night, so you can fly that day, but we do recommend you stay over an extra day because there's just a lot to see and do in this beautiful part of the world. Is it appropriate for someone brand new? It is, because it's kind of international investing with training wheels. On the other hand, I'm not sure someone's first investment should be an offshore investment. That has a lot more to do with you than it does with the marketplace. So we definitely get some newbies, but the vast majority of people that come on this trip own real estate in the country they're from and are looking to diversify. Now, a side benefit of you coming as somebody new is that you get to hang out with a lot of these people, and it's usually a small group. The last group, we had 17 of us, which was actually a larger group than usual because this is a small market to get around. You know, back in the day, we do the big bus tours. I remember, Russ, you and I did one to Phoenix with 4 buses full of people. That was insane. 12 in a boat is awesome. And then as far as airline codes and those things, we don't have any airline discounts. We do have a great hotel discount at the host hotel. You'll learn all about that once you sign up. I think the bigger picture, though, and maybe, Russ, you can add some color to this, is part of the reason to go on a trip like this is to learn about the market. But the other part of the lessons you'll learn that apply to any market you'll ever invest in.
Yeah, that's really the key. I talk all the time about patterns and principles, and that when you have an experience in one area of your life or you make an observation, I mean, you can look at nature and learn things about business. You can look at the human body and you can learn things about business or investing. So there are ways to glean patterns and principles. The work that you do when you analyze a market and try to understand what makes the market work, who's the demographic, what are the economic drivers, why would one property or location be better than another location, what are the options in financing, and so on. And even if you're thinking about investing interstate, I remember the first time we went outside of California and we started investing in other states, we had to become familiar with their laws. They had different landlord-tenant laws, which we found out were a lot better than California.
Yeah.
But we found out they had different conventions in terms of how you conducted transactions. There was all kinds of things, even different terminology. And so if you ever are going to think at some point down the road that you would be interested in international investing, then I think it would be a great trip. And you know what? Of all the different field trips you could go on, it is absolutely positively the most fun. It is literally like a vacation. It's a ton of fun.
Well, that's a good point. And it's always for us about relationships. And we just meet cool people on the Belize Discovery trip. If you're interested in that trip or any of the things the Real Estate Guys do, go to realestateguysradio.com under events. Patrick will hope to see you there. It's Ask the Guys. Your questions are answers. We've got some great questions coming up next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
Hear ye, hear ye. Registration is now open for the Real Estate Guys 19th Annual Investor Summit. Imagine spending an entire week with like-minded investors, world-class educators, and real-world professionals. Returning this year, our sales legend Tom Hopkins, the editor of the Gold Newsletter Brian London, international real estate developer Beth Clifford, and Jim Rohn's 18-year business partner Kyle Wilson. And joining us live and in person for his 9th Investor Summit, Peter Schiff. Plus, returning for his 9th Investor Summit, best-selling author and the Rich Dad advisor for real estate, Ken McElroy. Plus, lots more to be announced. It all begins June 11th in beautiful Belize. Visit realestateguysradio.com and click the tab that says Summit to reserve your spot. This transformational week is like no conference you've ever attended. Go to realestateguysradio.com and click Summit and make plans to spend a week with the Real Estate Guys, Peter Schiff, Ken McElroy, and an all-star faculty on the 19th Annual Investor Summit.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hi, this is Lawrence Yun, Chief Economist with National Association of Realtors, and you are listening to the Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Hey, if you ever want to do bigger deals using other people's money, or if you want to invest passively into deals too big for yourself, come on out to the Secrets of Successful Syndication right around the corner. All the details at the website, realestateguysradio.com. Under events, it's Ask the Guys, your questions, our answers. The next three are somewhat related, not the people, just the concept. Let's start with number one, comes from Alan. Alan says, hello, I'm addicted to your podcast, and I thank you for all your priceless hints and strategies. I'm in the process of pulling the lever to invest in a real estate fund. I have done enough study to know I want to work with funds. I'm an approved investor, he probably means accredited, and I want to get the money wired to begin. However, there are so many piles of paperwork relating to audits, PPMs, contracts, performance memorandum, etc., and to page through that will get me lost in the weeds. I now have what you often call analysis paralysis. How can I make sense of all this? What due diligence would you recommend? Hiring a lawyer to page through all this material would cost me thousands. Do you have a blog or podcast that addresses this? All right, Alan. Well, first of all, the topic that we're here to talk about as the show wraps up is these questions all have to do with investing passively rather than owning a property and having to hire a manager and putting together the financing. When you invest passively in a real estate syndication or private placement, then what you do is provide the capital and a professional manages the fund. Sometimes these are folks that have various funds doing different types of real estate. Sometimes it's someone who's a specialist in a niche. There's a variety of these. So if you're thinking about passively investing, you're going to run into the problem Alan's talking about, and that is there's a lot of paperwork. There's a lot to read through, think through, understand. I would say you don't want to short yourself. There's not a true shortcut, and Alan, I would be remiss if I didn't say you really should read every page. But that doesn't necessarily mean you have to get lost in the weeds.
Yeah, let me kind of break it down because this stuff comes up all the time. And I can tell you with the syndicators that we train, when we show them how to present an offering, we kind of break it down into pieces. So the first thing you have to look at is what is the investment objective? What is the investment thesis? In other words, what is the goal for the money? If you give them money, are they going to create equity? Are they going to create cash flow? Are they going to create privacy? Are they going to create tax breaks? And is that what you want your money to do? So that's the first alignment. The second thing is what's the investment thesis? How are they going to produce that result? Does it make sense to you? Do you buy into their plan? The next thing you have to look at is the team. And you've already said you've done enough work to know that you want to work with these people, but you have to look at the team. Are these people competent? You have to trust them in several major areas. We call them the C's. The first one is their character. Are they ethical people? Number two is their competency. Are they able to do the work? Number three, do they have the capacity to do the job? Are they overloaded? Do they have a commitment to do a good job? There's probably some other ones, but you kind of get the idea. So you got to vet the team. Now, once you've vetted the team, then you have to actually look at the deal itself, if it's a deal. Now, you said a fund. Sometimes funds are blind funds, and now you're really just underwriting the team in the investment thesis because you don't know what the deal is. But if they're putting a deal in front of you, you got to look at the deal, and you got to ask yourself, the deal is three things. The deal is the market that it's in. And does the market make sense based on what the investment objective and investment thesis is? Does the team have a footprint there? Do they have capability or capacity in that market? Maybe they're great. I mean, we saw one of the greatest developers in Florida try to come in and make their mark in Las Vegas, and they laid an egg because they had no team, they had no footprint, they had no reputation. They were strangers in a strange land. You remember that, Robert?
$1 billion company. So these were no lackeys. This was a well-known, I wouldn't say household name, but in real estate, everyone knows their name. And they were huge in a couple of markets, New York and Florida. They came to Las Vegas and they left with their tail between their legs.
Yeah, so that kind of thing can happen. So you have to take a look at that. So you got to look at the market. Then you have to look at the demographic that the particular investment is going to serve, because demographics have different needs, right? There's seniors, there are affluent people, there's low income, there's students, there's special needs. I mean, there's all kinds of different people out there, and you have to ask yourself, do I buy off that this product, this project, this market has enough of the right people and it's going to meet those needs? You got to look at the economy and kind of what is going on in the economic environment, which is tied to the demographic. And then, of course, you have to look at the actual product, the deal itself? What is the property? And does that make sense? And then when you talk about the paperwork, you're going to get some key things. One is your private placement memorandum, which is going to describe the deal and it's going to explain the risks. And you should understand the risk. Robert taught me a long time ago, you read through all those contracts with a highlighter and you highlight anything you don't understand. Now, those are the types of things that you can go and you can ask questions of the person presenting it. If you get a satisfactory answer, that's fine. If you're still confused, then you can talk about going and getting a lawyer instead of just handing him, 8 inches of paperwork and paying him thousands of dollars to read everything. And most lawyers will find something wrong because that's their job. So you just ask them very pointed questions about things that you're confused about. You can do the same thing with your accountant. When you're going over the numbers, do the numbers make sense? If you're not financially trained, if you don't know how to look at the financials then hire a CPA to go through it and actually look at the numbers for you and see if it makes sense. And then, you have to, it's not just is the math done properly, because sometimes you find math errors, but the other thing is, are the inputs correct? Are the things that you could check probably pretty easily publicly, like the rents, is that normal and customary for this market? Is the price that you're paying for the property, is that normal and customary? So you can look at some of those basic inputs. And if those all check out, now you're starting to feel like, okay, I feel good about the goal. I feel good about the thesis. I feel good about the team. I feel good about the market. I understand the demographic. I understand the property. The numbers make sense. I understand the risks. I think I'm ready to go.
Now, Alan, that sounds like a lot of work, but just for some perspective, imagine instead you were going to flip a house. Find a house, find a neighborhood, get bids, go in there, hire contractors, spend a lot of time at Home Depot or Lowe's. That's a lot of work. What Russ just described is a lot of work, but here's the perspective. Once you've done that work and you've vetted a deal and a market and, more importantly, a fund manager, now that work continues to pay you dividends as they have another deal and another deal. If it goes well, you become a regular client. If it doesn't, you've learned a ton about how to do it next time. So it's not that passive investing is zero work. If you want zero work and you want real estate exposure, buy a real estate investment trust or a home builder stock or something like that. Do the work up front and it will serve you well. Now, we've got 2 other questions that are kind of related. Lubomir in London, Great Britain says, hey guys, I'm a UK-based real estate investor. I'm interested in investing in multifamily real estate in the US. Can you please let me know if this is possible? And if I want to invest with your company, can you describe steps about processes, rules, administration? My goal is to invest like an LP, a limited partner, passively. And then in the future, I plan to move and live in the US and maybe do my own deals like a general partner. Can you help me with my journey? Thank you. Now, before we answer that, our next question from Daniel in Las Vegas says, hello, real estate guys. First of all, I'd like to thank you guys for the content that you produce. Thank you, you bet. Love it. I'm really grateful. Secondly, I have a question. Could you guys please provide me with some syndicates for multifamily or self-storage syndications? I'd really appreciate it. Thank you. All right. The reason I lump those together is just so we can be clear. You can invest with our company. We don't solicit investment on the radio. That's not what we do. We have a background in syndication, but no, we're not using the show to fund deals. So that's a no. And secondly, do we point to things like multifamily and self-storage? Well, not directly, so we're not going to answer that question with a list of names. Having said that, the most important concept is this is a relationship business, and the real estate guys do foster some incredible relationships and do have some resources if you're looking for passive deals.
Yeah, I mean, as far as getting started in multifamily in the United States, we have a supporter of the show, Brad Sumrok, and Sumrok Apartment Investor Mastery. I think you can send an email to Sumrok, Sumrok, at realestateguysradio.com, and you can get information about Brad. He's got a training program. He mentors people in doing this as limited partners, and then also he teaches them how to form their own deals. And so that's something you might want to take a look at.
And many of his courses are available online. So if you're in Great Britain, you don't necessarily have to jump on an airplane.
Yeah, but the other thing is you can come, and he does put on live events. He puts on some really great live events, Robert. You get a chance to speak at them. I get to speak at them every once in a while. Great teachers, really a strong program. We've seen a lot of people have a lot of success. So anyway, I mean, I think the thing is to the main theme that we always talk about is it's a relationship business. So it's less about a course as it is connections. So if you take courses so that you meet people, including instructors, advisors, mentors, and the other students in the room. So you will learn things, and that's important, and you do need to know things. But if you learn them in the privacy of your own home, you've really missed out on the main purpose. The main purpose is to get in relationships with people. You can do that virtually, but if you have the opportunity to go live event, I highly, highly encourage it.
Well, in fact, we mentioned our syndication event, which is coming right up. We do it twice a year. I can't think of a better place to be to meet a whole bunch of these types of fund managers, people that are raising capital for self-storage and multifamily and businesses and a huge variety of types of real estate, and it's all passive investing to the limited partner or the person that comes in as a member. So that's a great place to network. Maybe it sounds self-serving because we're promoting our seminar, but we've already got well over 200 people coming. So it's not like we're begging for people to show up, but we would love to have you. And I think, especially for you, Daniel, in Las Vegas, easy to get there. But I do think that just getting around people that are doing deals is huge. If you want to get to the point where Alan is, he's already interviewing fund managers and teams and looking at their paperwork. Well, you got to meet those people. Online is not a great place. There's a lot of smoke and mirrors online when it comes to passive investing. You know, one of the quick shortcuts there is when you click the About Us button and there's no people's faces, it's just generic prose about their integrity. Run away from that, as some of those sites don't actually belong to people that are in the business. They're just lead magnets. So I think it's a belly-to-belly, face-to-face business. I'm going to invest money with someone I know, like, trust, and had spent time breaking bread with. Come on out and meet some people like that, whether that's in your local market, at one of our events, at other people's events. That's how you do it. So while we also don't point directly, we do have a really cool thing called Investor Registry. It is in its infancy. You can find out more about that if you go to theinvestorregistry.com, theinvestorregistry.com, and you can learn about how deals that come across our desk can make it to your desk. Well, that's today's show. Great questions. We'll do another one in a few weeks. We've already got some questions stacked up, but if you'd like to ask a question of the Real Estate Guys, get to the website at realestateguysradio.com and click the button that says Ask the Guys. Big thanks to Mauricio Raul for popping in today. In fact, next week, Mauricio will be on the show. We're going to do an awesome program about the legal aspect of real estate and when not, you need to consider bringing in legal counsel. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers. Low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct. Asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.